I think gold and the mining stocks are still the best way to play this war because we still have no idea whether the war is over or not. And the war could just as easily be back on Monday as it was off on Friday. And if the war is back on and it escalates, everything is going to go down. If the recent pattern holds, then gold will go down too. But I expect the recent pattern to eventually break because the war is bullish for gold. Now, gold's going up regardless of what happens with this war. But certainly, the longer the war continues, the better it is for gold. I don't care how the markets have been reacting to this short term. It doesn't even matter what the Fed does with rate cuts because if the Fed doesn't cut rates, rates are still going down because inflation is going up. That is the bigger problem, which means real interest rates have been falling the whole time, that the markets have been focused on what the Fed is going to do. The fact that the Fed has done nothing means it's done something.
Geopolitical uncertainty continues to shape market behavior, with gold remaining a central asset amid instability. While short-term reactions may vary, the broader trend suggests that prolonged conflict environments tend to support higher gold prices. Volatility across asset classes can lead to temporary sell-offs, but the underlying demand for safe haven assets remains strong. This creates a backdrop where gold continues to attract long-term capital. PeterSchiff, a longtime advocate of gold as sound money, explains that even if markets initially react negatively to escalations, the structural drivers remain intact. Rising inflation and stagnant policy responses are pushing real interest rates lower, historically benefiting gold. Even without rate cuts, increasing inflation reduces the real value of returns elsewhere, strengthening gold's appeal. As geopolitical tensions persist, the environment becomes increasingly supportive for precious metals. All this means that even if gold's price jumps around in the short term, the big picture is what matters. As inflation heats up and uncertainty grows, gold's reputation as a safe store of value comes into focus, driving its price higher. Now, we present the clips from PeterSchiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Meanwhile, gold and silver, they rallied. Gold was up 2.5% on the week. We're not above 5,000 yet. In fact, we're not even above 4,900, but we are above 4,800. Gold closed well off the highs today. It was only up about $40 by the end of the day. I think earlier today it was up about twice that much. But gold closed just below 4,830. Silver had a much better day and week. In fact, silver closed the week back above $80, $80.70. And in fact, intraday, silver traded above $82 today. And silver on the week gained 10%, almost 10% on the week. So silver actually beat Bitcoin on a weekly gain. The mining stocks did okay. You know, there was some weakness in Newmont that helped pull the GDX down. It was only up 1.9%, so not quite 2% on the week. But the GDXJ, which, that stock has a smaller impact. In fact, I don't even think it's in there. GDXJ was up 4.5%. So just a little bit less than the S&P. But, I think gold and the mining stocks are still the best way to play this war because we still have no idea whether the war is over or not. And the war could just as easily be back on Monday as it was off on Friday. And if the war is back on and it escalates, everything is going to go down. Now, if the recent pattern holds, then gold will go down too. But I expect the recent pattern to eventually break because the war is bullish for gold. Now, gold's going up regardless of what happens with this war. But certainly, the longer the war continues, the better it is for gold. I don't care how the markets have been reacting to this short term. The markets are wrong. They're all trading off of the oil price and the impact that they think that is going to have on the Fed and whether or not the Fed's going to cut rates. It doesn't even matter what the Fed does with rate cuts because if the Fed doesn't cut rates, rates are still going down because inflation is going up. That is the bigger problem, which means real interest rates have been falling the whole time, that the markets have been focused on what the Fed is going to do. The fact that the Fed has done nothing means it's done something, because the Fed has allowed inflation to go up without matching that with rate hikes. And so the Fed is allowing interest rates, real interest rates, to fall. In fact, the Fed's balance sheet continues to grow. The balance sheet, again, in the most recent week, up about another $11 billion. Now we're over 6.7 trillion balance sheet. Again, the balance sheet is up over $200 billion this year. The Fed is doing quantitative easing. Money supply, as I said, is up better than 5% year on year. This is a highly inflationary monetary policy, and it will be even more inflationary the longer this war continues. So I think that when you play with gold, you could win both ways. If the war is really over, gold's going up. But if the war is back on, gold may go up anyway, because eventually that is going to happen. But obviously the war continuing is not a good thing for the markets, even though we are at record highs in the S&P and the NASDAQ. But, you know, we got some inflation news. Speaking about inflation, earlier in the week, we got the March producer prices. And the markets actually rallied on this news because the numbers came out better than expected. And better means lower when it comes to inflation numbers, because the markets were looking for a 1.2% rise in prices on the month, March. And of course, March is the month where we started the war and oil prices shot up. But we didn't get a 1.2% increase. It was just a half a percent. And the February number that was originally reported at up 0.7 was revised to up 0.5. So the market was relieved. Year over year, producer prices only rose by 4%. The consensus was 4.7. So this was, hey, good news. But it's not good news. Who cares what the expectation was? Look at the reality. Year over year, prices were up 4%. The prior month, they were only up 3.4. That is double the Fed's target, and we're headed in the wrong direction. We're going up. We're not going down. And even if you strip out food and energy and you look at the core, prices were up less than expected. They were up 0.1. Expectation was 0.5. And once again, they revised down February. But year over year, the core is still up 3.8. Yes, it's slightly lower than the 3.9 from February, but nowhere near 2. And even though it's inched a little bit lower, I don't believe these low numbers. I think they're going to be revised the other way. I don't know how it is that the number was so low, even though it was still high. It should be a lot higher, and it probably will be a lot higher when we get these April numbers. But this is bad news, and this shows that rates are too low, and they're going to continue to stay low.
Gold and silver posted strong weekly gains despite volatile market conditions, with silver leading the way and outperforming several major assets. Gold held firm near key levels, while silver surged back above $80, reflecting renewed momentum. Mining stocks followed, though with mixed strength, indicating selective participation within the sector. These moves come amid heightened geopolitical uncertainty and shifting macro expectations. Looking ahead, inflation remains stubbornly high, even if the headlines say otherwise. Producer prices are still climbing, central banks are growing their balance sheets, and the money supply keeps expanding. With real interest rates dropping, conditions look very friendly for precious metals fans. If markets focus only on quick policy news, they could miss the bigger story. Inflation and expansion are here to stay. That's why gold keeps moving forward, no matter what news shakes the day. As the fundamentals keep favoring hard assets, gold's upward journey looks like it's just getting started. Let's get back to the interview.
Henry Paulson came out and issued a very strong warning to the United States about a coming sovereign debt crisis. Now, of course, I've been talking about this on my podcast continuously. That's what I'm warning about, that we're headed for a sovereign debt and we're headed for a currency crisis. And the war just accelerates that whole process because of the cost of funding the war and because of the impact the war has on the debt and the size of the debt. Remember, Trump wants to raise military spending from $1 trillion to $1.5 trillion. That's another $500 billion that we have to borrow, right? So that accelerates the process. But Henry Paulson said that the United States needs to have an emergency break the glass kind of plan in place now to deal with a sudden collapse in demand for U.S. Treasuries. And he says the effects of that will be vicious. And so we need to have a contingency plan, an emergency plan. Like, what are we going to do? Now, first of all, what took him so long? You know, thanks for nothing, former Secretary Paulson. Hank Paulson was the Treasury Secretary in George Bush's second term. That is when we had the 2008 financial crisis. That's when we had the bailouts, the bank bailouts, TARP. That is when the Federal Reserve started quantitative easing. QE1 happened under Paulson's watch. And Paulson worked very closely with Ben Bernanke on these bailouts. And so he was kind of an architect of the very crisis that he's now warning about. Why didn't he do something instead of just saying that, you know, the current Secretary of the Treasury should develop a contingency plan to deal with the emergency that he helped set in motion? Why didn't he do something back then? Why didn't he think about this stuff back then and say, hey, maybe this isn't such a good idea that we do this quantitative easing stuff? Maybe we shouldn't do these bailouts. In fact, while he was Treasury Secretary, maybe he should have seen the warnings that I saw. Because as I was warning about the imminent crisis, he wasn't warning about anything, right? He was just thinking everything was great. But now, you know, when it's way too late to do anything, in fact, he's not even talking about we need to start preemptively working to try to prevent this crisis from happening. That's not what Hank Paulson is saying. He's not saying, hey, we could be in for a real crisis if the demand for treasuries goes away. So let's do something before that happens. Let's try to prevent this crisis before it starts. Let's head it off at the pass. Let's do something. Let's get our house in order, because if we wait for this crisis, it's going to be vicious. That's not what Henry Paulson is saying. He's saying, let's do nothing, but just have a plan to deal with the crisis when it happens. I mean, what the hell kind of advice is that? I mean, once you know that a crisis is coming, wouldn't the most prudent thing to do to be, let's try to prevent it, let's try to avert it, let's try to change course, let's recognize this. Maybe we need some emergency government spending cuts or some tax hikes. We need to reduce the size of the deficit so that we don't have to deal with the emergency. Let's prevent it. No, all he's saying is we need to have some kind of, emergency to deal with the crisis when it hits, because it's inevitable. That even shows you how bad it is, because he doesn't even think we should do something to prevent it. Just have a contingency plan for how to deal with it. But the problem is, there is no way to deal with it. I can't even imagine what the hell that plan would look like. It's almost like, a suicide. Like, just, what's behind the emergency glass? You break the glass, and then there's a revolver there, and you shoot yourself in the head, because there's no way to deal with this crisis. And, you would think that people in markets might take him seriously, because he was the Secretary of the Treasury. He's supposed to be one of the guys that knows something, right? I mean, people don't care what I say, right? I can talk about this till I'm blue in the face, and nobody in the mainstream gives a damn, right? It's all, I'm a broken clock, I'm a perma-bear, I'm a doomsayer, so what do you expect me to say? But that's not the reputation that Henry Paulson has. And so why is he wrong? I mean, the current Secretary of the Treasury isn't saying this, but a former Secretary of the Treasury was. So why is the guy we got now any better than the guy we had back then? But so far, nobody seems to care. Nobody seems to be paying attention to it. But you know who does care? Our creditors, our international creditors. That's why the world is moving away from the dollar. That's why the world is moving away from treasuries. That's why the world is buying gold. And Henry Paulson can see this happening. And he knows that this crisis is inevitable. And all he can think of is, we need a plan to deal with it, when there is no way to deal with it, because it will not just be vicious. It will be completely catastrophic.
Warning signals about sovereign debt are growing louder as fiscal stress builds in major economies. Rising deficits, expanding military budgets, and a bigger thirst for borrowing are putting pressure on the system. If confidence in government debt starts to crack, capital could move quickly, especially if demand for sovereign bonds suddenly weakens. At the same time, global investors are already adjusting. The gradual shift away from traditional reserve assets toward alternatives, such as gold, reflects growing concern about long-term currency stability. This shift is not driven by headlines but by structural imbalances that have been building for years. As debt levels rise and policy options narrow, the margin for error continues to shrink. The financial system is walking a tightrope, not becoming steadier. In this unpredictable world, preparing for bumps and building resilience into your assets is more important than ever. Share your thoughts in the comments below. If you found this analysis useful, please like this video, subscribe to the channel, and turn on notifications for more updates.